Hello, everyone. Today on the final bar, we're going to focus on relative strength. We have a couple segments focusing on the relative, or the message of relative strength, how we can use it to differentiate between different stocks, sectors, and themes, especially important now as you have the market fluctuating around key resistance, more range bound, but you have leadership and laggardship sort of evolving. Relative strength is one of the best ways to do it. Market's selling off here in the early afternoon. What does that mean for the long-term trends? Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a cold and rainy Redmond, Washington. Thanks for joining us every weekday after the close as we look at these markets together, try to make sense of things, how the long-term trends have evolved, focus on price momentum, how that momentum is shifting. We're recording this a little earlier in the day on Wednesday, but just before the close, about 3 p.m. Eastern. So the market coming off pretty good after the after the lunchtime hour, sort of back toward the lows of the day. So it's interesting to see where we close. We're going to update as much as we can going through the show, but obviously focusing on where the close and where we end up can be pretty key. I did want to make a point. It's obviously Veterans Day today, so schools closed, bond market closed, but a special thank you to all the veterans out there, those that served. Very much appreciate your sacrifice and your contribution. In terms of our guests and our schedule coming up, we've had some wonderful guests. Yesterday, we had Brian Shannon on the show, who's a really thoughtful trader and educator, but he focused on his indicator anchored VWAP, which we have on our ACP platform. So it was a really good, a really nice taste of that indicator. If you missed that, it's worth reviewing. Tomorrow on the 12th, we have Craig Johnson from Piper Sandler in Minneapolis coming back on the show. Craig, when I think of Craig, I think of multiple times over my career where we have disagreed on the market environment. He has been wildly bullish when I've been wildly bearish. Just a couple times in history, he has been right so far, pretty much 100% of the time when that's happened. So I will let you know the next time we have a friendly wager, but it will be great to have him on the show, see where he's at now with the S&P testing 3,600. Next week on the 17th, we have Jesse Felder. And then on Wednesday, Joe Duarte, a frequent StockCharts contributor, coming back on the show. Some great guests coming up, and so far, we've been super fortunate with who's been able to come on the show with us. Let's get to our market recap. So as I mentioned, we're recording this a little earlier, so we're going to update where the markets are at late afternoon, obviously see where things play out, and plenty of earnings. We've got Disney reporting earnings today, if I remember right. So, and again, plenty of earnings coming out that could certainly fluctuate things after hours. But, overall today so far, it's been about technology regaining the driver's seat, essentially. We've had this stretch where the FANG trade or the FANMAG trade or whatever has been rolling over, and sort of that mega cap tech communications consumer trade has rolled over, and things like small cap value have been the number one contributor overall to the market returns in recent days. Also have seen an emergence of small cap leadership, which is very different than the small cap laggardship we've seen for much of the year. That has all reverted back. We have a bit of a mean reversion. So technology up the most at so far today, up 2%. Materials, energy, industrial, sort of the late cyclicals down the most. Energy has been, obviously had a pretty impressive bounce off of fairly weak relative levels, and today giving a bit of it back. Small caps really weaker through the course of the day, traded lower and continued on. So the NASDAQ leading higher. So it definitely a mean reversion. I think as we look at the charts and as we get to some of our segments later, you're going to notice that, while the FANG stocks are up good today, they're coming off of, a pretty good pullback, whereas things like small caps are down a bit, but coming off of pretty elevated levels. So it's a bit of a mean reversion. The question I would have is this a short-term mean reversion? I'm hearing people talk about, this is the return of the FANG trade. I don't know if I'm there yet, because most of those stocks, if not all of them, still haven't broken above resistance yet. We'll look at the charts together and see what we can see. The VIX back down today, back below 24 again. This is coming off of obviously pretty elevated levels. Bond markets closed today for Veterans Day, so you'll see a lot of flat lines when you look at the bond markets, and that's why that is. We'll see you as they catch up in trading tomorrow. Dollar up just a little bit, but not too much. In the commodity space, you had gold and silver sort of mix, gold down, silver higher. Oil prices sort of flats up a little bit, but not enough to get energy out of, again, a bit of a mean reversion downswing today. Let's look at a chart of the S&P 500 here. As we look at a daily chart, we've talked about this range from 3,200 to 3,600. Again, on Monday morning, I'm looking at the S&P going to new highs, going above 3,600 for the first time. And I'm thinking, man, this is lights out. This is S&P 3,800, 4,000 something above and beyond going through year end. Like, this is accelerating. But I think the way that Monday closed can be pretty telling. Instead of validating a breakout, instead of indicating that buyers had taken control and pushing us to new highs, that buying power sort of dissipated. And by the close, it actually closed back below the open. And by any measure, that's certainly a short-term negative signal. And instead of validating a breakout, sort of validates the importance of 3,600 as a key resistance level. Yesterday, you sort of chopped around a little bit. Today, again, it was going stronger, but now kind of coming off here in the early afternoon. So it'll be very interesting to see the close, but I don't, barring some huge move into the close, it means we're still going to close within this range. So overall, I think, my base case is you still have plenty of time to fill in this general range. And I think we could overshoot it and I think we could undershoot it, but I don't see us moving materially higher at this point, again, until proven otherwise. Again, with the big rally, the big gap up this week, we still weren't able to break above the September high. And most stocks are in that similar, many stocks in that similar case. So we'll have to see if that label or if that level continues to be able to hold. But at this point, I think S&P 3,600 is the level until we're able to eclipse that. It says we're range bound, and we have to wait and see what's going to happen. We touched on some of the sector themes. If there's anything noteworthy, everything's sort of on the script of offense on the top, defense on the bottom, except for consumer staples, which is kind of an interesting one, number 2. So it's going to outperform consumer discretionary, again, stopping the clock right at this moment. Has a better day than consumer discretionary, which is an interesting phenomenon as if things are sort of, we're talking about this, the strength of the FANG trade. That certainly doesn't include staples in there. So a bit of an outlier outside of the normal rotational playbook right now. Looking at stocks up or down, again, you have some pretty good mean reversion here. You're seeing some semiconductors in the top 10 scooter gainers, things like AMD, KLAC, and others. I think it's worth noting that some of these, like AMD, for example, have been beaten up just a little bit, right? So while semiconductors as a whole have done pretty well, and the long-term relative performance has been pretty good, AMD looks almost more like the XLK, looks more like the broader technology sector, where instead of testing new highs, the upswing today, and again, up 4%, that's great. This after yesterday, it was down pretty good. So it's not even regaining yesterday's open. And here we're sort of confirming this sideways pattern. Again, this is what concerns me about thinking S&P, is going to blow through 3,600 and not look back. I'm not seeing breakouts on a chart like this, which would convince me that we have enough juice to continue to the upside. Same with most of the FANG stocks. Are sort of still sideways, sort of chopping around that range. And until you get a decisive move higher or lower, obviously, that would tell you, where things could be going. Next. On the downside, things that have been rolling back are, some of the retailers. So here you see Ross Stores, TJ Maxx on the down list. Simon Property Group down pretty good. A lot of this is sort of the give back on the hotel travel sort of trade. Airlines I haven't looked at yet, but let's bring up the chart of Delta Airlines, DAL. So, stocks like this that sort of gapped up pretty good. I mean, this is up pretty significantly. If you look at the chart of Delta Airlines, it hit 37.50, which is not coincidentally, I think, right where it topped out there in June. So back above the 200-day, that's impressive. Totally fair. It's broken above its swing high from September. Totally fair. But this is actually not even regaining its June high yet. It actually hit that, and that's resistance. It's coming back off of it today, finishing, at this point, more toward the lows of the day. So, I think some of these stocks that were sort of the, vaccine has been announced, everything's going to get better tomorrow. It's sort of trade is what it certainly felt like on Monday. I think you're seeing that rotate back down as people are more, maybe mentally setting back into the reality of what, how a vaccine rolling out would actually play out. And again, it's not, not our place here to be commenting on or to be speculating on the rate of a vaccine rolling out, but it's more to focus on the charts and the message that I think is inherent on what's happening. And what you saw here is a gap higher on Monday on euphoric news. And then since then, sort of a back to reality, meeting resistance and failing, and now coming back down to the low. So on a chart like this, again, it's not totally broken yet. Airlines are not my favorite chart, don't get me wrong. So I think you're looking back for, pull back to this congestion area, pull back to the moving averages. I think 3750 is certainly the line in the sand. And I would be looking at some of those other airlines and finding similar things. American Airlines a little different because it actually gapped up right to its 200-day and came back off there. So I'm seeing failure signals in the short term on these charts. I'm not seeing a resounding things are better for a group like airlines. If you look though, again, I'm just bouncing around, sorry, randomly, but so where I'm at thinking with things. AMD is certainly weaker, but if you look at the semiconductor EMF, SMH, up pretty good. And I think the tech sector, number one, up about 2% here in the afternoon. Semiconductors almost double that here at the same point. So a leading group, leading sector certainly has been doing well today and recovering a bit of the sell-off from the last 48 hours, the last two trading sessions. That's certainly a chart I would always encourage you to keep an eye on. And again, that chart holding up and appreciating certainly speaks to the inherent strength underlying the market. That is our market recap, bouncing around through some of the different themes we could tease out today. We're going to take a quick break. We'll be back with our next segment, Compare and Contrast. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, we'd love to hear from you. Feedback on the show, and in particular for that, if you go to StockCharts.com/TV, we have a survey running right now. I'd love for you to take a few minutes and just answer some questions on there. We're trying to gather feedback as we prepare for 2021 and beyond, trying to improve our programming, the quality, the content, all of that. Even harsh feedback aimed at a particular host like myself, I would love to hear it. So please take a moment, if you could, go to our StockCharts TV website, answer the quick survey, give us some feedback so we can improve what we're doing. Also, get your questions to us. The Final Bar at StockCharts.com is our email. Also on Twitter at FinalBarSTTV, and on our YouTube channel, just put a comment below the video. We look at everything you send in, and we will answer some of those questions in our next mailbag segment at the end of this week on Friday's show. Our next segment is called Compare and Contrast. What we'd like to do is use the power of stock charts to look at two different charts, two different sets of charts, really, and as it's named, compare and contrast the patterns. What can we see with those two charts relative to one another? So what I wanted to do today was sort of link into this this mean reversion we saw today. This sort of the cyclicals like industrials have been improving. Things like technology have been rolling over a little bit on a relative basis. That's sort of switching back a bit today. But what does that mean relative to the long-term trends? What kind of things can we see on those long-term patterns? To do this, we're actually using the gallery view. And if you've never used gallery view on stock charts, it's a pretty powerful capability. If you click on the little drop down next to the ticker box at the very top, you have gallery view. You can type a ticker or type two different tickers separated by a comma, which is what I've done here. It will compare the two charts right alongside of one another. It's a really cool way to compare two different things on an apples to apples basis. Now, my charts are going to look a little different than the ones that you look at on your login, most likely because I've customized these gallery view charts. And if you don't know how to do that, you can make each one of these look exactly how you want. At the top, you see this little message in gray. Click on Learn How, and it'll tell you how to create chart styles to customize what this page looks like in your own login. So we are going to use mine. We're going to jump to the daily view and focus really on the daily and the weekly views here. So here what we have is industrials on the left. We have technology on the right. We're looking at the last year on a daily price basis with the 50 and 200-day moving averages. Below, we have the 14-day RSI. And then we have that ETF relative to the S&P. So if you've watched this show for any amount of time, this looks pretty familiar. It's kind of my standard, daily chart that I use if someone asks me to look at something. That's just usually where I start. So a couple thoughts on here. When you look at the last year, when you think about the performance of these two, anecdotally, you think of technology as being, the strongest, if not one of the strongest sectors. And I think that has absolutely been the case. And if you start the clock at year end 2019 and you go through the September market peak, and again, this is the XOK, it's not the market, but the S&P peaked out around the same time. You can see that's absolutely the case, right? The relative performance exceptionally strong. I mean, outperformed by about 25% year to date, ending at the beginning of September. That's pretty impressive run. You look at something like industrials, start the clock here, you look at the September market peak, and it's down about 12, 13% over that same period. So certainly it was technology, especially mega cap tech versus everything else. And you see something like industrials really just struggling. And even after, the March to May period where it underperformed, even then still hadn't dug out much of that since then. But an interesting thing has happened since the September market peak. If you look back to the chart of the S&P, which is this one, this is what I'm talking about. Here's the S&P market peak here. We've then had this sideways pattern for the last 2 months, really a congestion pattern, a consolidation pattern, a coil, if you will. And I would argue really this is this is the market overshooting and undershooting an equilibrium price, which is right at the February high. I see this essentially as a big, double topping pattern, I think, until we break out with some sort of confirmation. I think it's still the general feeling I see with the price, with the breadth for sure. So looking at these two, how does that compare? Well, if you look at what's happened over that period since the September peak, you can see that actually industrials have laid out a pretty strong relative case. If you start the clock at the September market peak, this is where things like industrials, materials, utilities have actually outperformed. You look at the chart of XLK, it is nowhere near its relative peak that now again, it's only 4% underperforming over that point. So don't get me wrong, maybe a little bit more than that. So, don't get me wrong, it's not absolutely disappeared, but on a relative basis, you can see it's been underperforming flat to down, whilst things like utilities and industrials have been outperforming. And if you look at the price, it sort of confirms that. Now, industrials, along with some others, and things like airlines are included in this, but you can see the big gap higher that you saw on Monday. You got a bit of a gap, but it really didn't gap up on the XLK. It sort of, traded higher, actually closed back within Friday's range at the end of the day. So while the XLK, you could actually draw a trend line using the September peak and the October peak, and we broke above it on Monday, but really still haven't closed above that line. We're potentially doing that today, but it still hasn't confirmed that. If you look at the XLI, it actually broke above it, and it's still within Monday's trading range. So while other sectors have given it back, industrials have actually held up. What's most interesting on this chart, industrials broke above their February peak just this week. And I think that level of support, which is 84, is pretty important. And even go down to the gap level around 82. I think that 82 to 84 level is really pretty effective. And I would assume if the industrials are able to hold above there, I think that speaks to strength going into next year for sure. Well, not for sure, for certain, but that's certainly what the chart would suggest. If you look at the XLK, though, it's more of a story of consolidation. While industrials have consolidated and now broken out, you don't get that breakout signal on technology. So while today is certainly impressive, you can see that tech is up while industrials are down. In terms of the take a step back, look at the last couple months, even go back to the last year, you can see the technology had a huge run going into the September peak. Since then, it's actually flat to down, while industrials are actually continuing to outperform on a relative basis. So that's one point to focus on. The second one is to look at these longer term charts. And when we think about the rotation higher in industrials, the rotation lower in technology on a relative basis, look at the weekly PPO. You actually got a sell signal on the XLK about a month or two ago. On the industrial sector, you actually have not gotten that. You got a buy signal on both of these back in the April to May period. Industrials have remained positive. Technology has actually rolled over a little bit. So on a price basis, had a huge run and now has stabilized sort of again, consolidating on price, but momentum rolling over, relative strength rolling over. You also have a pretty good bearish divergence here with the peak in February and the peak in September with lower highs in the momentum while you have higher highs in price. You don't really have that in the industrials only because we've gapped above there and you see that the RSI is rotating a little bit higher. So when I compare these two, technology seems to me, it's speaking to me as being a performer really strong into the September peak, but things have changed since then. And while today certainly indicates, and I think is getting people optimistic about the potential for technology to reclaim a leadership position. We haven't seen it yet. And I think that's the one thing to pay attention to as we compare and to contrast these two different sectors and these two different charts. That is our segment, Compare and Contrast, again, using the gallery view tool to compare two different assets. It's a really cool way to compare two different things you might be looking at. If you're comparing two stocks and trying to evaluate which one you would want to get in, do gallery view, enter two tickers separated by a comma, you're going to get to this point. Our next segment, it's all relative, continuing our discussion of relative strength. And we're going to focus here on some of the relative performers. I want to hit on a couple different themes when I think of relative strength. First off is to look at sort of the stay-at-home trade. In particular, we're going to look at Zoom and Peloton. So if you look at a chart like Zoom and if you look at a chart like Peloton, they both have had obviously incredible years, really accelerating through through this coronavirus stage, and on a relative basis, outperforming the S&P by still over 400% for the year, but at its peak a couple of weeks ago it was about 200% more. So it's had an incredible run by any measure. What's interesting, though, is it's certainly pulled back below the 50-day moving average. That's a bit of a concern. In the tactical time frame, making a short-term pattern of lower highs and lower lows, that's certainly a concern. And so as a trend follower, I would much rather see higher highs and higher lows than the opposite. What's interesting, though, on both of these charts, if you look at the relative strength obviously incredibly strong through much of the year, has given a lot of that back in the last 3 weeks or so. It was really heading into the election season and where we're at since then. This stock has retraced 38.2% of the way, and that was an interesting level to pay attention to. The gap down on Monday, as the market's gapped higher, a lot of stocks gapped higher, like the charts we just looked at, industrials and others. Zoom and Peloton actually gapped lower, followed through a bit yesterday, but now trading right back above that 38.2% level, which is just below 400. It's around 380, 85, we'll call it. So this is a key level to watch, and I think a stock like this able to hold its 38.2% retracement level on its first real key pullback since an exceptional run is very, very important. If it breaks that, I would be looking down to this next level down, which is the 61.8% level. It's the 200-day moving average. It's this consolidation range from July that puts it around 260, 270. Now that's another 100 points down from where we're at right now, which would be a pretty strong downtick for sure. So I think this level is where you'd expect things to hold, and I think a strong chart that's pulled back to a buyable point. That's sort of the sweet spot. That's called the fat pitch chart. Pretty decent place to expect a bit of support. We're also going to look at Peloton here. Give me just a second to bring up the chart that has the Fibonacci retracement. Same thing. Now this one bottomed out in March. Zoom actually rallied in the beginning of the year in the first quarter. Peloton, as with many things, sort of bottomed out in March, then really accelerated. And you can see the relative strength really came out there, still up 275% year to date, in the last year, relative to the S&P, but had been up as much as 400% just a couple weeks ago. Same sort of pattern, though. You can see this is pulled back again to the 38.2% retracement level. We talked about this a couple days ago. I think what's important here when things gap down is noting that it gapped down to its first Fibonacci support level. That actually coincides with this congestion range you had in September. It is also around 100, that big round number. And a lot of times when a stock comes down to 100 from above, that is the moment of truth. Is this a double-digit stock or not? And if it's still a triple-digit stock, then this is the time to probably want to accumulate more as it would bounce higher off of the 100 level. If it breaks below there, you see, some people would certainly treat that as a change of character and an increased potential for further downside. If it does, again, looking at the Fibonacci levels, next support would be just below 80, around 79. The one below that, which would coincide with the 200 days, around 64 to 65. So the problem you have with some of these charts is if they break this Fibonacci support, there's a lot of downside on a price basis, on a percent basis to get down to some of those levels because of the severity of the upswing up until then. But if you ask me to make an educated guess, I would assume these levels hold, and I think they've given them a lot back from their runs, which is tends to be a pretty viable bounce within a long-term uptrend. That's sort of what the data would usually support. So that's kind of how to think about some of those key stocks that have pulled back. And again, reversion higher could be pretty meaningful in both of those charts. I also want to talk about some of the groups of stocks we've looked at, in particular today with the FANG trade really sort of rallying to the upside, I wanted to look in particular at those charts. Tell you why I'm not wildly optimistic on this FANG trade returning, and I see this as one day, but not necessarily a pattern just yet. So here is the index, the FANG Plus Index, $NYFANG. You can see overall very similar to what we see with the broad market. It's range bound, and if you look, 5,800 is really the line in the sand. That's the resistance level. Just like the Netflix chart, you have sort of a triple top pattern, a resistance that's now been tested 1, 2, 3 times, which means that is a huge resistance level, a lot of overhead to overcome. If it does get above 5,800, I will be the first to tell you this is clearing the way for potential further upside, but we're not seeing it yet. With a lot of these individual charts too, you can see many of them have pulled back obviously in the last couple of days. Today bouncing up higher sort of in the late afternoon hours, but all of them for the most part pretty much below still their previous peaks. Here's Facebook, the F in the FANMAG group. You can see again a nice short-term pattern after the pullback from the September peak. You can see it's sort of chipped away, higher highs, higher lows. 260 is the support level. That's probably the most impressive in terms of its ability to keep reclaiming and making new swing highs. So at this point, a bit of a pullback, a nice hammer candle, you could call it yesterday, or maybe a dragonfly doji if you really want to get into your crazy candle terms, but short term, certainly more positive again. But I think overall, it can rally up to 300 and still be within a consolidation period. Apple, same thing, with the obviously a big event yesterday, the One More Thing presentation, and bouncing up a little bit today, which is nice, but 125, the next level I'd want to see it eclipse to feel like there's more upside. Netflix a little more concerning. So here, instead of Facebook, we had higher highs and higher lows. Here you have the opposite. You have Netflix making lower highs and lower lows, and this is bouncing off of a new swing low. I think this level around 470 or so is really key, and that's the support coming off of that first sell-off there in July, and I think that's a level you'd want to see it hold. It has so far, so overall it's sort of at the lower end of that range. Microsoft is essentially in the middle, but again, every time it's tried to get up to this 220 plus level, we've rotated lower. So until it's able to eclipse that, I'm not assuming further upside as well. Amazon, again, bouncing off from relatively, the lower end of this range, so still range bound. Out of all of these, if one of them is most impressive, I would say it's Alphabet. And if you look, Alphabet is the one out of those 6 that is broken above its September peak. You can see it pulled back and retested that there yesterday. So I think that is certainly a line in the sand. Just to give you a quick visual here, we take the horizontal line. You can see where I'm talking about. This right here was the peak from September. You can see we've now broken above it. That holding, I think, would be one of the FANMAG stocks breaking to new highs and holding it. That would be key right now. Otherwise, if it breaks back but down there, you have all 6 of those still range bound, and that tells me that the upside in stocks is not clear yet. I think we can still chop around and have individual names breaking out and breaking down for an extended period of time. That's all the time we have for It's All Relative. Boy, I'd love to focus on many more of these. We'll have to save it for another show. We need to wrap the show. 3 and 3 charts, 3 minutes. Here we go. Chart number 1, the S&P 500 with percent of stocks above the 200-day. I do not mean to be overly negative here, but I'm seeing patterns that line up with previous market peaks. If you look, 85% of the S&P here in the late afternoon, and again, this is updated through Tuesday's close, 85% of the S&P above their 200-day moving average. The last couple times we've gotten that high have been in January of 2020, before granted one more swing higher, and then the top in January of 2018, which is pretty much right before the market turned lower, and March of 2017, really late February. Now that one was a little shallower pullback of about 2 months, but all 3 of those meant within the next month you were weaker rather than stronger. You certainly had some distribution. So that's what concerns me, is so many things now have rallied. It's lining up with previous topping patterns. Now the XOK, we talked about technology a little earlier when we were comparing it to industrials, and I would say the relative rotation of technology going down is one key part. I'm not going to get super excited about the S&P breaking out, given the fact that technology, the XOK, is still range bound. However, I would say this: there are plenty of stocks breaking out. Semiconductors as a group within technology certainly looking stronger than others, and I would encourage you to look deeper, look next level down within different sectors to see where the opportunities might be. Finally, I'll finish with consumer staples. Interesting to note, this is actually a sector that is retesting its all-time highs, potentially making a new 52-week closing high, even more than that today on Wednesday's trading. So it'll be important to see how consumer staples sort of hold in there. And that idea of consumer staples underperforming consumer discretionary has been brewing for a while and has been the case. Could we get a bit of a reversion and see staples rotate higher? Folks, that is our show for today. Thank you so much for joining us every weekday after the close for the final bar. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a good night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.